Matt Weber here with Weber Group Home Loans, and today we're going to be talking about bridge loans. Now there are a plethora of products out there, but we're going to be talking about using a line of credit on a home you currently own to buy another house. In this video, I'm going to go over what exactly a bridge loan is, when to consider using a bridge loan, the costs associated with the bridge loan, the risks associated with the bridge loan, and then things to watch for with a bridge loan. So what is a bridge loan? A bridge loan is a short-term loan used to provide temporary financing until a person or a business secures a more permanent or long-term financing solution. It bridges the gap between an immediate need for funds and expected future availability of funds. Now to put that in context for this video and for real estate, we're talking about taking a bridge loan or a line of credit on a home that someone currently owns and then putting it as a down payment and closing costs for a home that they will be buying. When to consider a bridge loan? I think the most common scenario is when someone finds their dream home, they currently own a home, they want to use the equity from that house to buy this other house, but they don't want to write a contingent offer and miss out on that property. It may also be that they just don't want to go through selling that house and buying that house at the same time. And after they buy that house, they might want to prep their house to sell and make it look better and get more money for it. Bridge loans offer a ton of flexibility in that scenario. And what you can do is if you go under contract and you sell your house before you buy the other house, you can just cancel the bridge loan. It's super easy. Qualifying for a bridge loan. Now this is really the only tricky part about bridge loans. You have to qualify for that new housing payment, that house you're going to buy, your current mortgage, whatever you owe on that, and the bridge loan. So as long as it fits your debt to income ratio, it's going to run through underwriting much like a regular conventional or FHA loan would, but you do have to qualify for all three mortgage payments as well as any other debts you have. Now these are not regular conventional FHA or VA loans. These are portfolio loans and they're typically run through a broker outlet or a credit union. So the qualifying process might be a little bit more strict. They might have higher credit score requirements, a little bit smaller debt to income ratio requirements. But the bridge products that I've used, they do know that speed is a really important part, and typically they can close these in about 2 weeks. The cost associated with the bridge loan. Now this is where you really have to do your homework because the fees are kind of all over the place from company to company. But typically you're gonna see an upfront charge and some origination points, and then you're gonna see a higher interest rate. Those upfront charges can go anywhere from 0.5% to 2 to 2.5%. And then the interest rates are typically going to be 1.5% to 2% higher than a regular mortgage rate. Now keep in mind, it's a bridge loan, it's a temporary product. So even if the rate is 2, 2.5, even 3% higher, your goal is not to keep that rate for a long time. Once you sell that house, that loan gets paid off and you don't pay interest on it anymore. Also, these are interest-only loans. So your payment is actually gonna be a lot less than you think if you're used to a 30-year fixed payment. So the payment will be relatively low, but you are paying more in interest. And really the goal there is to get that house sold as quickly as possible, but the flexibility is really what you're paying for there with the fees and the rates. Now there are risks associated with bridge loans. One of the biggest risks is what if that house doesn't sell? If that house doesn't sell, you're basically stuck with a home equity line of credit at a slightly higher interest rate. It's not the end of the world, but you will have to make your 3 mortgage payments. You're gonna pay that new mortgage payment, the old mortgage payment, and the bridge loan mortgage payment. So you'd be stuck with 3 payments for a while. Now my advice there, if you're worried that house is gonna be on the market for a little while, is you can actually just pad that bridge loan. So let's just say you need $100,000 for the new purchase of your home. That's gonna cover your down payment and your closing costs. If you're able to bridge a little bit more, maybe borrow $120,000 or $130,000 on that bridge loan. That way you're giving yourself $20,000 or $30,000 of padding, and when you close on that new home, you're gonna basically wire $100,000 to the title company, and then they're going to cut you back that $30,000 that you're not putting down, and that goes in your pocket. That way you create a reserve fund for yourself. That way, if it does stay on the market for a while, you've got that padding there, you've already accounted for those mortgage payments to come out of that account. And then obviously once that house sells, you can dump that equity back into the house, whatever hasn't been paid out on that. Another risk, and I'm sure real estate agents don't want to hear this, but it's the real estate market. If the real estate market were to decline and you took a big bridge loan and you pushed the loan to value or the amount of loan to the value of your home really high, if you want to sell that house, you could end up upside down and have those 3 mortgage payments. So that's definitely a risk to consider depending on the market that you're in and how much you're borrowing on that bridge loan. Because if that's the case, then when you go to sell that house, if it's declined enough, you might actually owe money to sell that house. And then there's obviously risk of default. You've got 3 mortgage payments. If you start to fall behind, they are gonna collect on those. They'll give you some leeway, but for the most part, you don't want to find yourself in that spot. So if you find that using a bridge loan in that scenario works, but it doesn't fit your personal budget and it really isn't comfortable, it's probably not a good idea for you to take out a bridge loan. Things to watch for when picking a bridge loan. I wouldn't worry so much about the rate because most of them are adjustable and very similar in rate. You want to look for the upfront charges. How many points are they charging to do that bridge loan? The nice thing is if it's a true bridge loan where it's a line of credit, they're only going to be charging you points on the amount that you're borrowing. Now, some of the other products out there, I believe Knock does this, they're going to charge you 2 points or however many points they charge on the entire value of the home. So you want to see what those charges are based off of, if they're based off the loan amount or the whole value of the home. Because if you're selling, say, a $900,000 house, but you're only bridging $100,000, that 2% on $100,000 versus $900,000 is a huge difference. So you really want to watch the fees there. Another thing you want to watch is if there's any balloon payments in the terms. They have to spell that out for you. And what a balloon payment is it's basically saying after a certain amount of time, you owe all the money back from the bank that's left on it. So if it were interest only, and let's just say it's a 2-year term with a balloon on that 2 years, let's say you borrow $200,000, you make your interest payments for 2 years. At that 2-year period, you either have to refinance that or you have to come up with $200,000 to pay the bank back. So you want to watch and see if there's any balloon terms mentioned in there. You'll want to also make sure that bridge loan lender is in close communication with the lender on your purchase, because they're going to have to work hand in hand to make sure underwriting on both sides goes through smoothly and that you close on time and the money gets there. Bridge loans are actually really great products and they don't get talked about that much because I think a lot of people are afraid of them, especially lenders and real estate agents. They don't understand how they work and how easy they can work. I think people assume that it's a HELOC or a regular line of credit where it's going to take you 45 days to do it and they just opt out of that as a solution. But they actually close pretty quickly, the terms are very straightforward, and it's an awesome product if you're looking to buy that dream home, not write a contingent offer, and take time to sell your home and get top dollar for it. If you do decide to go this route and take out a bridge loan, just make sure you do your due diligence, run worst case scenarios, make sure that all fits your budget, and then pick lenders that you know and trust. My team and I would love to help you on the mortgage on the purchase of that house, and then we can also refer you out to a bridge loan lender that we know, like, and trust. I hope you found this video helpful. Please like and subscribe. It really goes a long ways. Thanks.